Even if it doesn't always take center stage, repo is in fact one of the most vital components of modern financial markets. It keeps the wheels of these markets turning by moving cash and securities around the system, where and when needed. Repo is the main way that banks and other financial institutions borrow and lend cash or securities, often bonds, to each other for short periods of time. Repo is sometimes called the plumbing of the market, and just like the plumbing in your home, you are unlikely to think about how it works until something goes wrong. And yet it is a market that globally has an estimated turnover of around $6 trillion a day. Repo is actually short for repurchase agreement, a form of secured borrowing and lending where two parties, usually banks or other financial institutions, agree to the sale and future repurchase of securities under the terms of a legal agreement. At its simplest, a money market fund, for example, might be holding cash that it would like to invest safely on a short-term basis, earning some extra interest for investors. While at the same time, an investment bank needs cash to fund its day-to-day trading and is holding securities which it can use to borrow on a secured basis. They strike a deal. On day one, the money market fund buys the securities from the bank and pays for them in cash, the purchase price. At the same time, the bank agrees to buy those or equivalent securities back at a later date, for example, in a week's time, at a pre-agreed price, the repurchase price. The difference between the purchase price and the repurchase price is effectively interest to the cash lender, in our example, the money market fund, and is known as the repo rate. As a result, the bank gets the cash it needs and the money market fund makes some money for its investors. In this way, the repo market is bringing together institutions with extra cash that they are looking to invest safely and over a short period of time, like money market funds, pension funds, or insurance companies, with those market participants that need cash to fund their day-to-day trading, such as hedge funds or investment banks. Banks often stand in the middle of these transactions, acting as both sellers and buyers in the repo market, thereby ensuring that all market participants can access the repo market whenever they need, a role that is often referred to as market making. For cash lenders, a repo is a relatively risk-free transaction because the securities they receive in return act as collateral. This means that if the borrower institution is going into default during the life of a repo and cannot repurchase the securities as agreed, the lender can sell the securities to the market to get its money back. And as an additional safety net, the market value of the collateral securities will usually be greater than the price paid for them at the beginning of the repo. The difference between the market value of securities and the purchase price is known as the haircut. Repo is also extensively used by central banks as a key monetary policy tool. When a central bank lends cash to banks, they generally do this through repo, taking suitable collateral in return. This minimizes the risk for the central bank and allows it to control interest rates more effectively in the market, which in turn will have an impact on the real economy. Finally, both parties to a repo deal need to have a contract in place to set out the business terms that they are operating under. The Global Master Repurchase Agreement, or GMRA, is the most widely used contract in the cross-border repo market. ICMA commissions legal opinions on behalf of its members every year on the enforceability of the agreement in nearly 70 countries. Repo transactions happen every day on a huge scale, but with minimal risk, allowing the financial markets to run smoothly, maintaining market liquidity, facilitating the flow of collateral, and ultimately supporting the global economy.